Hello, and welcome to Virtual Investor Conferences. My name is John Viglotti, and on behalf of OTC Markets, we're very pleased you joined us for our next live presentation from VersaBank. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome David Taylor. He's the Director, President, and Chief Executive Officer of VersaBank, which trades on NASDAQ and the TSX under the symbol VBNK. Welcome back, David.
Well, it's my pleasure, and thank you everybody for attending this. I've got a fairly unusual story to tell you about a bank that I founded. At the beginning of it was in 1993. I was a little bit of background on myself. I'd worked for one of the large Canadian banks, actually on a task force to convert that to what they called the MEC mode, i.e. the computerized mode in the rudimentary days. And then I had the honor to work for an international bank, a British bank. And somewhere along the line, I thought to myself, it was fine working for a bank, but much better to own a bank. So not having a whole lot of money, and necessity is the mother of invention, I thought I could create, at that time, it was a rather unique model for a bank, a branchless digital bank that would use partner model. I set out to do that, and in 1993, I prototyped it, and then in Canada, managed to get the elusive federal bank license that had eluded everybody for 18 years, I guess. So after I managed to become a federal bank in August 2002 with a branchless digital model. Now, having the luxury of being able to form a bank virtually on a whiteboard, I tried to do away with all the risks that plagued the banking industry, and still does today, of course. So excessive lending risk, it seemed to me that small banks were always tempted into making loans to people that really shouldn't have loans, or markets that they shouldn't participate in, too risky. So I managed to mitigate the credit risk significantly, and at this point in time, we can say that we've hardly had any losses whatsoever. No losses, no material loss at all in our 30-year history. The use for people, I'm a little prejudiced on this, being a person myself. I thought if I could do away with the need for a lot of people with software, I would do it. So I managed to create new banking software, though there was no example of this type of software available in 1993. So I created PC-based software. Actually, we call it banking in a box some time ago. And still, at this point in time, with 4.4 billion or so in assets, we're only about 100 people running that portfolio. Deposit risk, that's been the downfall of many banks. Of course, recently we've seen just how fast deposits can depart a bank. So I want to eliminate the risk for deposits disappearing. I thought first things first, you build a bank's roots, which is its ability to raise deposits economically. You'll see how I did that. Economic exposure, I thought, how do I create a counter-cyclical business so that when others are whining about credit risk accelerating and recessions and terrible things, COVID things and liquidity crises, our bank won't be hit with that. And then the inefficiencies, of course, that come with the branch network, I eliminated along with all the other inefficiencies of dealing with those pesky humans that take up a lot of time and distract the bank from its mission of making as much money as possible. So moving along, what are you looking at today? It's a fully digital North American bank. We're licensed presently throughout Canada as a federal bank, and hopefully very soon we'll be able to race the U.S. border and have the privilege an honor of being an OCC federal bank. For those that have followed us, we have agreed to purchase a small OCC bank located smack dab in the middle of Minnesota, which is just wonderful for me because I spend a good portion of my summer just north of Minnesota on an island at Rainy Lake that separates Minnesota from Northern Ontario. So I'm very familiar with Minnesota. And hopefully we can conclude that purchase soon. And in effect, our cloud-based bank then will be able to serve the entire continent of North America. Really risk-mitigated model. I'll talk in a slide or two about how I managed to take credit risk down to almost zero, not quite zero, of course. Nobody can get credit risk to zero, but I got it pretty close. I guess with that 30-year history, with no loan losses, that illustrates that. Earnings growth has been spectacular in the last while, and it's just a matter of the math. Our fixed costs are fixed, and the more assets we add, the more interest income we earn, and that drops straight to the bottom line as our fixed costs are fixed. Outsized growth, well, son of a gun, the United States has got to be the biggest market in the world for our product, which is point-of-sale financing that we prototyped in Canada. So, holy smokes, we're sure looking forward to bringing this product to the United States in a big way. And then you not only get a bank if you buy our shares, you actually get a cybersecurity firm that has got virtually zero value. Our stock is trading a little less than book today, so of course no value for the cybersecurity firm that I created. It's called DRT Cyber, David Roy Taylor Cyber. And why did I do this? Why did I create a cybersecurity firm? Well, obviously, I didn't want my digital bank to fall prey to the modern day bank robbers. A little anecdotal history. While I was going to university, I was actually taking a master's in biology at the time. I got a job as a maximum security prison guard, and I got a chance to meet in those days old school bank robbers where the tool of choice was a sawed-off shotgun. So fast forward many years, I thought to myself, those new bank robbers that may be residing in their basement are going to have a tough time with our bank. So I created DRT Cyber to keep our bank safe first and foremost. And being the entrepreneur that I am, I thought, well, if it's keeping us safe, it perhaps can keep other high-value targets safe. And presently, DRT Cyber has about 400 of the who's who in North America as its clients. And that would be transportation lines, large police departments, states, energy companies, all those enterprises that just can't afford to go down, including other large banks, of course, from big retailers. So it's a very successful cybersecurity firm that is a wholly owned subsidiary of our bank, and it resides there with, I think, a lot of value. But strangely enough, the market doesn't seem to perceive that right now. So the next slide here just shows you sort of graphically how we're put together. You see the two logos, one dead center of North America. That's Saskatoon, Saskatchewan. That's one of our tech facilities, and we're proudly resident on the university campus, the University of Saskatchewan's Innovation Place. We occupy one of the floors there. It's a wonderful place for a tech company to reside, and I've used the Top Gun theme there. It's a target-rich environment for IT people, as all kinds of wonderful, intelligent, motivated, creative university students looking for work, and we've got a tech center right in the middle of their campus. The other tech center is at London, Ontario, and that's a little historical. When I was a British banker opening the bank in London, Ontario for Barclays, I resided in London, Ontario, and I built this tech center at the London airport. And that's because we like to have the convenience of being able to show up in person with some of our partners. And I'm a pilot, and I've been a pilot for decades and decades. There's a long story about that, too. I created an airplane. I call it Skybed at one time. And I thought having access to the airport, i.e. being able to taxi right out from our facility and show up in New York in the space of 60 minutes or Minnesota in 45 minutes is what a cloud-based bank like ours needs to do. So that's why we have 2 tech centers, no branches, of course. Heaven forbid we didn't want branches. Just 2 tech centers that we could look after the entire world from a functional point of view. A cloud-based bank, our cloud facilities located in Iowa, and that's it. So looking at either side of the circle, you know that we have lending partners on one side, the right-hand side, and on the left-hand side, we have partners who raise deposits for us. So that's our interface with the retail market on both sides. So our staff, the 100 of us, don't actually have any dealings with the end customers either way. We have a data record that represents them, and hopefully we never actually meet them in person. That's something that would have gone wrong with our system if we actually had to meet them in person. And that's how I put the model together. Moving along to the next slide. With respect to when I say ultra low risk bank, and I know this audience is attuned to how banks operate. There's a myriad of risks that we banks face, but credit risk is one of the big ones. And this little line graph here illustrates that I'm walking the way I'm talking. Our provision for loan losses over the 30-odd years has been the average of close to zero. I've given you back to 2017. And that's what you'd expect. If you don't actually have credit losses, then when we do our ECL calculations and such, it doesn't reveal a provision for our portfolio. And I'll get into another slide and show you how I managed magically to do away with all that. And then with respect to the liquidity risk that a lot of banks face, and I'll just paraphrase what a regulator said to me fairly recently after SVB failed. Well, what if there's a run on your bank, David? And I said, well, where are they going to run to? We don't have any branches. And then the person sharper than average said, well, what about your website? They could just take the money out and move it to somewhere else in an afternoon. And oh my goodness, you'd face a liquidity crisis. Well, we don't have a fancy website that folks can get high rate data interest savings accounts or move their money out. We don't employ that model. And why would we? Because we don't have to. So we take deposits from a deposit broker network that I established with telephone modems in 1993, put together, and now it's emulated by a lot of small FIs across North America. In those days, it was a novel new concept. But that means there is no way to get your CDs prior to maturity from our bank. So liquidity risk, credit risk, the 2 big ones, eliminated with the model. So moving along to this next slide that shows the deposits I was referring to, and also it illustrates when I said we designed ourselves to be somewhat impervious to downturns in the economy. So looking at the lower left-hand side, you see wealth management. That's the 120 or so partners that raise deposits for us, and you see the logos there. Those are the big guys in Canada. They raise deposits for us, send the data to us electronically, and then when the deposits mature, we send the money back to them electronically, and the data flows between us. Wonderful.
David, Lawrence interrupting here. Apologies in that we don't have those 2 slides in the deck that we're using for this group. We will let everybody know that those 2 slides are available on our website. So apologies for the interruption. And let's skip ahead to the momentum in profitability and long-term earnings capacity. So we're not confusing anybody. Although if you want to spend a couple of minutes talking about the deposit side and the lending side,
no problem at all. We're all virtual, and I'm sitting here with my laptop, and I brought up what I thought was the very last presentation. But I should just pause for a sec and say to you, because I'm sure everybody's intrigued, how has Dave managed to create a bank that is somewhat impervious to downturns in the economy, which other bankers are all whining about, of course? Well, what I thought I would do is provide a custom banking package for the insolvency industry, and I did. And we built some wonderful banking software for the insolvency industry, rolled it out, no advertising. You build it, they will come, and we've got about 80-90% of English-speaking Canada dealing with us. So when everybody's worried about recessionary times, what that really means to us is our insolvency clients raise more deposits as they're winding up people's estates, more economically priced deposits for us to offset credit issues that a recession would bring. Hate to gloat, but we're moving into one of those periods of time when there's way more insolvencies than there used to be. So that means more deposits for us economically priced. So moving along to the momentum, I'm sure this is what shareholders are really interested in, is how we make money. And in other presentations, I've said maybe the word bank isn't the right moniker for what we've created here. It's more like money-making machine that just happens to hold a bank license. The math is pretty simple. As our assets grow, we earn approximately right now 250 basis points, and net, that's 250 after provisions for losses, because we apparently don't have any provisions for losses. That would be the highest net margin in Canada. I realize in the United States, when we're finally given the privilege to raise deposits there, that should be better. In fact, our math shows around 4%, which is amazing. Thank you, U.S. depositors, for depositing with banks at a margin over the risk-free rate that's much less than Canada. So say 250 basis points times the assets equals our net interest income, and our fixed costs have been fixed, as you can see, at about 50 million. Subtract 50 from that, you end up with pre-tax earnings, and we got about a 27% tax rate. That's what gives rise to these beautiful numbers swooping upward and rapidly increasing return on equity and all those good things. Flipping over to the next slide, that's just what I'm talking about. Year-over-year loan growth was 23%. In fact, last quarter, the point-of-sale program grew 7%, which actually amazed me. Canada tends to be a bit chilly for folks buying in this quarter we've just finished. So normally you'd see a little less than 7, but they surprised us, and I'm looking forward to even more growth for the next 3 quarters in Canada. And then just dreaming in Technicolor, when we erase the U.S. border concern, that market might be 100 times bigger than Canada, and we've seen a whole lot of interest in our product, maybe 30 or so really good point-of-sale companies that want to adopt our model. Revenue growth 11%, net income up 35%, EPS up 41%. Yahoo! And for those that like to look at bank ratios, efficiency ratio was 40%, and that should just keep getting better because it's just math. Revenue, the denominator, keeps increasing, and the fixed costs. Hopefully, you don't see anything more than, say, a little inflation in the fixed costs, giving rise to pretty rapid increasing return on equity as we go through our inflection point. Next slide, 11. How do we continue to grow? Well, obviously, the big growth plans are United States, and that hopefully is not too long from now. We've been dealing with the U.S. regulators for the last 2 years. We think we've answered all the questions. If they have more, bring them on. The model's something, of course, I'm very, very proud of, and it's proven the test of time in Canada. 30 years since inception, and with the point-of-sale program, 12 years prototyped in Canada, worked impeccably, no issues whatsoever. Cost of funds, I'm always looking for neat ways to raise deposits even cheaper. Although the U.S. market, the deposits are so cheap, maybe we won't spend a whole lot of time on that. And it is possible accretive acquisitions going forward, but really the big one is just getting that OCC bank in Holdingford, Minnesota, that wonderful little village where the Holdingford Insurance Bank is operating. Okay, flipping along to number 12.
David, just a note that we're at about 20 minutes and want to leave some time for Q&A.
Sure. So I'll just speed through the rest here. 12 just shows you the size of the market in the United States. I'm looking at for point of sale, 1.8 trillion, at least 100 times bigger than Canada. So yes, we're really excited about that. Number 13, that's the slide devoted to telling you about the U.S. acquisition of Stearns Bank Holdingford. It serves the purpose for us by giving us access to the entire United States with our point of sale program and deposit raising. And number 14, another beautiful slide that shows as assets increase, ROE increases, efficiency just gets better and better. I put a few milestones up for you. 5 billion efficiency ratio, of course, mathematically drops below 40%, and ROE, all other things being equal, gets into the 16% range. Get to 6 billion, it just gets better and better. You get to 10 billion, it just puts numbers out of sight that are somewhat unreachable by other banks. 15 is DRT Cyber. Salvate on that. I mean, that's got to be worth a ton of money, and it's got zero value on our share price. So why should you buy now? Well, today in particular, the stock for some weird reason took a nosedive in the last couple of days and is actually trading less than book. Unbelievable. Inflection point, obviously, with those numbers I just showed you, the earnings are increasing quite dramatically. U.S. market's amazing. Risk mitigated model. Current valuations, well, son of a gun, are they really, really below where they should be? And profitable cybersecurity business is that free option. All right, ladies and gentlemen, I'm open for questions.
All right, David, our first question is about the U.S. point of sale receivable purchase program, and specifically with respect to the U.S. And what differentiates your offering with point of sale loans by your competitors, FinWise, Cross River, etc.? And I think maybe there's a false premise here that we're competing with point of sale companies, which of course you'll explain that we are not.
Absolutely. Yeah, we're complementary to the point of sale business. If you visualize this as a electronic warehouse that's designed to warehouse the loans and leases that the point of sale companies generate. They send those to us electronically, and they reside happily on our balance sheet unless they go 90 days in arrears. Then we have a put-back arrangement to put them back to whoever sent them to us. To ensure that we can put them back seamlessly, easily, we require any of our partners to keep a substantial amount of cash on deposit with us so that we can put back, our system puts back the loans, a debit to their account. So very complementary to the point of sale. People, no wonder I've got 30 or so back chomping at the bit to sign up with us, and there might be another 32. It's just a wonderful model. It enables the point of sale companies to get away with a lot less liquidity because they can sell the loans and leases to us if they want on a daily basis. So they don't need to batch them up and have a whole lot of liquidity without having a requirement for a lot of liquidity or even a lot of equity. Their return on equity figures go through the roof. If you viewed it this way, between the two of us, it's a true partnership. We've got a bank license. We got access to really cheap deposits. We're super risk averse, and we have a very good relationship with regulators, probably because we're super risk averse. And they know what they're doing when it comes to lending. Between the two of us, we get to have our cake and eat it too. We get super cheap funding source, and they get a reliable, convenient, economical source of funding for their loans and leases.
David, have you been speaking with potential partners in the U.S. and what's their reaction been to this idea, if so?
Well, we have indeed been speaking to them, and the reaction is, where do we sign? And just to prove the model out, we formed a company in Delaware called VersaBank, and we actually signed up 3 U.S. point-of-sale companies in order to sort of prove out the model and go through all the trailblazing legal work that's required when you enter a new jurisdiction. That was all done a couple of years back, and we're all set to go. So it's just simply being granted the authority to operate in the United States and to be able to bring this attractive model to U.S. point-of-sale partners. I think it'd be great for the U.S. economy, great for consumers, because inevitably market pressures being as they are, our economical pricing will likely filter through to give consumers a better deal, and small businesses, of course, use point-of-sale quite often too. So it's a win-win for everybody. The banker wins; he gets an abundance of relatively low-risk loans. The point-of-sale companies win; they get a steady economical supply of funding, and the consumers win too, and that they likely end up with our lower cost of funds filtering through the system to provide them with a more economical price for a motorbike. And everybody needs a motorbike or an airplane. Those are my go-to toys. But
David, let's assuming we get the U.S. Acquisition approved. How quickly and to what magnitude could the point of sale business in the U.S. grow?
Well, how quickly it could grow almost instantly. We've set it all up as a cloud-based bank to operate anywhere in the world, and we've done a lot of homework on hitching our deposit system up to the United States and how our point of sale would work. So virtually instantaneously, we can start signing up these point of sale partners that are lined up at the door for us. How big can it grow? Well, in Canada, we're $4 billion. It is 100 times bigger, so it could be $400 billion. But let's just say in the short run, the constraint will be the comfort that our regulators have in the growth. The regulators like to both sides of the border, or even throughout the entire world, they like to see new markets exploited at a reasonably prudent rate. So we in the first few years, maybe a few billion, $3 or $4 billion, depending on the comfort the regulators have. The excess demand we'll hopefully be able to place with U.S. banking partners, put the assets, if they are agreeable, on their balance sheet, and we'll manage them for them to be able to, in effect, grow the business a lot faster, but not have it all on our balance sheet, so that our regulators can be comfortable with this new product.
And David, let's say you got to $10 billion. What kind of efficiency ratio and return on common equity would you be looking at, ballpark, in and around that level of assets?
Well, you'd be looking at around 30 cents to earn $1 of revenue, 30% efficiency ratio, and you'd be well north of 20% return on equity. The math just does that, and that even with those numbers, I'm building in increases in non-interest expenses, which we can't really see that, but there's always new servers about, and maybe our cloud partners will push their fees up a little bit, things like that. But it's just the normal cloud-based enterprise that is hugely scalable. It doesn't involve a lot of people. There'll be a few more people because we do interface with our partners on a human-to-human basis. And as I was talking about earlier, we fly out and visit them on their turf and talk to them. Some come to London to see us too. So there's a little bit of additional overhead involved in that, but it's certainly not even close to the proportionate overhead that other banks face when they're old school branches and tellers and and websites and all that stuff that it's nice. I'm glad other people are doing it. I take advantage of it.
All right, Dave, that's the end of questions. Time for a quick sign off.
Well, thank you very much for your attendance. It's a pleasure to talk to you. I know you're all bankers, bank analysts, bank investors, and if you have any more questions, obviously I love this model, love to talk about it. So just set up a one-on-one with me. I'd be happy to talk to you.